Welcome back to another episode of Meta. In this episode, we're going to go into what a stock market is like, how the public markets work, how you can buy shares of a company, or rather, how you can buy into the potential of a company. And in general, we look into how all markets work, how people work with each other. We're going to do a bunch of exercises. We're going to see what short selling is. It's an introduction or a primer into the stock market. All right. So, owning shares of a company, there are multiple ways you can own parts of a company, or, you can be involved in a company, especially a public company. First thing is to own a share or a stock of the company. You become a partial owner of the company. With bonds, you become a partial lender to the company. A lot of people think that it's a few people who own a public company, but it's not. Usually the management team and the promoters of the company own much, much lesser than you think they do. And it's the public that owns a large majority of most public companies out there. And by public, I mean people like you and me. Now, bonds are when you become a partial lender to the company, right? So the company can actually borrow from you and it keeps giving you interest on this. We're not going to go into bonds in this episode, but let's talk about, in general, what does this structure look like? So the general formula to remember here is that assets minus liability equals to equity, right? You need to understand this. So on the left, we have the assets of the company. These are all the positives of the company, right? It could be the buildings, the technology, the investments, the intellectual property, some product that's working well. And on the right side, we have the liabilities, which is debt, which is bonds taken from people like you and me, some loan that they've taken from the bank that they have to repay, that sort of stuff. And then what's left, the difference between the assets and the debt, is the owner's equity, right? This is actual equity, which is useful. So when you own shares or stock of the company, it means that you are the partial owner of this part of the company. So to see the price of each share of a company, what you have to do is you have to take this owner's equity and you have to divide it by the total number of shares. So say if there are 1 crore shares available in this company, it means each share is priced at 40 rupees. So if a company owns 100 crores worth of assets, it owns a building, it owns a house, it owns cars, it owns investments, some products, IP, and all of that is worth 100 crores, and the debt or the negatives that the company has is 60 crores, then you only own the part which is the difference between the assets and the debt. So if you do 100 crores minus 60 crores, 40 crores is left over. Those are the positives of the company, and you own shares or a part of that. Right? So when you do 40 crores divided by the total number of shares, in this case, let's just assume it's a crore number of shares, that's 40 rupees per share. So if you spend 80 rupees on this company, you can buy 2 shares of this company and you can be part of that owner's equity. The idea is that over time, the assets of the company grows bigger and bigger and bigger, and the debt gets smaller and smaller and smaller. So that owner's equity portion, it becomes bigger and bigger and bigger, maybe by 10% or 20%. And that, for you and me, it translates into an increase in the value of the stock of the company. So if I invested 80 rupees to buy 2 shares today, I still have 2 shares 5 years later, but because the assets of the company has increased and the debt has decreased, now my shares are worth much, much more. So if that difference increases by, say, 10%, then my shares are now worth 10% more. So the same 2 shares are now worth 88 rupees. Right, so I'm going to, in this entire series, we try to do practical exercises. All of this is just, it's theory unless I show you an actual live example. So here's an example of Reliance's balance sheet, right? This is on their financial statement. You'll find it on their website. So on March 31st, 2018, you can see that their total assets is, and all of these numbers are in crores, you can see it's 6.17 lakh crores. Those are the investments, and you can see all of that, right? Investments, receivables, cash, financial assets, loans, everything that they've given out, the inventories, it could be buildings, it could be products, it could be the chappals that they have in, Reliance Footprint, which is their kind of shop for shoes and slippers. So all of that included comes up to 6.17 lakh crores. On the other side, on the right-hand side, you can see the equity and liabilities. You can see that the owner's equity in the company is, and you can see those numbers, you can see the total equity is 3.14 lakh crores, right? This is the total owner's equity. This is the amount that's on the, the bottom right of that screen previously. And the total liabilities of the company, which is the borrowings, they've borrowed some stuff, they have to pay some other people, maybe some vendors, somebody came and did graphic design for them and Reliance has to pay those guys, financial liabilities, other current liabilities, provisions, deferred taxes, all of that included is 3.02 lakh crores. And if you total it up, if you total the equity and the liabilities up, sure as hell, you get the same numbers that you got on the total assets, which is 6.17 lakh crores, right? This is the cool part. Now, if you took this entire, total owner's equity and you divided it by the number of shares that are available for Reliance to purchase, you will get the share price of the company, right? And now here I'm showing you the last traded price right after their financial statement, which is 1294 rupees. But if you look at the actual numbers on that day, if you do the math, if you just divide the total equity by the number of shares owned by different shareholders, you will get a slightly lower value. Why is this value that it was trading at higher than the actual calculated value? I just put out a formula. You calculated that formula and we came up at a number, say 1000 or 1100. Why is this number slightly higher? Or why would a number be slightly lower? And the reason for this is you have to understand the stock market. When a company puts out its financial statement and people can go to a public market and buy shares, they don't buy shares from the company itself. That happens only during a company's initial public offering where you can buy shares directly from the company. Otherwise, you buy shares from each other on the stock market. So when one of these statements come out and say the stock price is or the calculated price is maybe 1100, somebody can go in and say, hey, this stock, today it's worth 1100, but I think at some point in the future, it might be worth 1250, right? And now all the other people can guess and they can speculate and say, okay, maybe it's worth 1250. I'll buy a share at that. And then somebody else comes in and says, no, I think the share is worth 900. And somebody can come and buy in that. So this trading happens on a daily basis, and this trading is between people. The company is not involved in these day-to-day stock trades between people. So all the shares, once they are put into the market, people trade between themselves, and that is what causes the stock price of the company to reach a particular number. Now, this is exactly the same as people going to, a crowded market. One person saying, hey, here's my goat. The other person saying, okay, what is that goat worth? I think it's worth 50 rupees. And this guy negotiates and says, no, I think it's worth 70 rupees. And then over time, maybe, the number of goats in the country is less. So the price of goats goes up. These are all speculations, and it starts with people. Now, on the stock market, what happens? What prevents somebody from coming in and saying, okay, I think Reliance is worth 3,000 rupees, right? The thing is, nobody's going to buy that. Nobody is going to say, okay, I'll put in money and buy that share at 3,000 rupees, because there are other people offering the same shares at 1,300 rupees or 1,500 rupees. So most people usually go for the lowest bid, right? And usually, people who are very bullish, who think that a company is going to go up or do well, who think that, some news has come out, some new technologies come out, they're not going to wait for the next year's financial statement, right? They're going to say, I think the company is going to do well. Let me make a buy order for slightly higher, right? Let me show you what this looks like. So the bidding process is simple. You go on one of these platforms, on either the BSE or NSE or, on an ICICI DMAT or one of these trading platforms, and you choose a stock. Suppose you choose Reliance. You put in a number, you say, I think Reliance is worth 1,300. Maybe you have one share of Reliance, you put in a bid, you say 1,300. Somebody either accepts it at your price or ignores. If they accept, that becomes the new current trading price. If someone prices higher than the current market, it means that they think the company's equity is worth more than it currently is, right? If somebody prices lower, then they think the company is going through a bad time or will have a drop in price. All of this is very speculative. I've said this many, many times before. Money is not a static object, right? Its value changes according to people using it, right? And especially with stocks, its value is different depending on who's looking at it. If you know something that another person doesn't, it is your imperative to go out and, utilize that information. If you think the company is not going to do well, then you can price it lower. If you think the company is going to do well, then you can obviously, make a slightly higher bid. So owning shares of a company. So every time you own a share of a company, a dividend is a cash payout made per share you own. Like I said, when a company has certain profits, those profits are distributed among all the owners of the company, including public shareholders. A stock dividend is a dividend made in the form of additional shares rather than a cash payout. So you have one share, and sometimes a company can say, hey, we'll give everybody one extra share, 1 + 1. Or we'll give everybody 0.1 extra shares, right? Or, one share for every 5 shares or something like that. So it's done by companies to reward and incentivize loyal shareholders without giving them actual cash, right? You're just giving them more shares, which are fictional value until they get proven in the real world. This in the crypto world, this is known as an airdrop. If you have, say, 100 bitcoins, I can give you an airdrop of another 10 bitcoins. I'm not giving you money, but I'm giving you like a little more of the number of things that you own. Stock dividends aren't taxed until the shares are sold by an investor. Now, this is an interesting piece because if I gave you cash, then you'd have to pay tax on it. Whereas if I give you stock dividends, until you sell it, you don't have to pay tax on it, which is the beautiful part about stock dividends. And a lot of companies do this. So there is the idea of short selling, right? Which is something that Elon Musk is not a big fan of. So if you think a company is going to do badly, you can make a bet that the stock price is going to go down. If you believe a company is going to do really badly and equity will fall, you can short the stock. So basically what you do is you rent a share, and this is a little bit of a complex idea. You don't need to go into the depth, but you rent a share and then you sell it. So if somebody's selling you shares at maybe the price of shares is 1,200, you rent the share for a bit at 1,200, you pay the actual market price, you sell it, and then the thing about stocks is they're fungible. So if you have a bunch of different sellers and they're all, or a bunch of different people and they're all they all own stocks, and there's a broker, and you go to the broker and you say, I want to take this one share from you. If he's taken shares from multiple people, if he's managing shares from multiple people, it doesn't matter which stock you've sold. You can sell any of those stocks, right? So assume you think that Reliance is going to go from 1295 to 600. So today you take that 1295, you rent a share and you sell it at 1295, right? You actually sell the entire share. If it goes to 600 tomorrow, you were right on your belief and you can cover your short, which is now that you made 1,290 and the actual value of the share is 690, you can just give it back to the guy who sold you the share, the broker, like I mentioned. And you can just give it back to him. So when you rent a share, like renting anything, you don't pay full price for it. You pay maybe 1/10 of the price every month or 5% of the price over 2 years or something. But if you give it back, it's like borrowing a book from the library. You go to a library, you borrow a book, maybe you're paying 2 rupees as the rent for the book per day, and maybe the book is worth 200 rupees, right? And you read the book, you maybe read 1 or 2 pages, and then you realize that people are buying the book on eBay for 1,000 rupees, right? So what you do is you take the same book from the library and you go sell it at 1,000 rupees, right? Somebody's giving you 1,000 rupees and you're still paying 2 rupees in rent, right? The library doesn't know that you've sold this book. So what you then do is you go to a bookstore, right? And now maybe the price of books has fallen and it's gone back to maybe 100 rupees. You buy the book at 100 rupees again. And you go and replace the book in the library. And this is what I mean by stocks are fungible, right? Nobody knew anything has changed. But you have made a lot of money. You've made almost 900 rupees minus, the few days of rent. So about 800 and something rupees you have made because you bought the book at 100 rupees, but you sold the library version of the book at 1,000 rupees, right? So basically you're giving the share back to the broker, which is like a library in this case, at some profit. So you sell high, but you buy low. So this is the thing about knowledge, right? In the stock market, the more information you have, the better decisions you can make, even in the microseconds. High frequency Wall Street traders, they gamble large amounts of money on knowledge about specific events. If you know for sure a company is going to do well or going to release a new product and you think it's going to get popular and you've used that product, then buy their shares, right? Eventually, you'll see how much you know about the market by how much money you make. So at the end of the day, a lot of people make theories about the market. People in the media, they say, yeah, this company is going to do well or that company is going to do well. But to be honest, if you really think that something is going to do well, put your money where your mouth is and actually buy that share, right? So that's how it works. That's how the stock market works. Wrong information will cost you big time. Today, the problem with, say, something like the media where they say a company is going to do well or badly is they're not penalized for it. They don't have to lose any money for it. Whereas you as a trader, if you ever become a trader, you are invested in that company. And if you are wrong, you will lose money. The right information at the right time will make you lots of money very quickly, right? And being accurate is far more important than hard work in the real world, right? A lot of people think that hard work is the crux of doing well. It's not. It's knowing the right things at the right time. Be a predictor and make many bets first, make many small bets. And I'm not talking specifically about the stock market, right? I'm talking about generally in life. The more you do, the more action you take on your predictions, whether you put money behind it or your effort behind it, then you will realize where you were right and wrong. Simply sitting and building out theories, and this is my biggest problem with academics in general, right? You just sit and you make theories about something which you don't know anything about. You haven't taken real effort or monetary risk for it, and you're just making predictions, right? You have nothing to lose, so you're going to consistently make predictions. But if you actually try something and you lose at it or you win at it, that's when you feel good or bad from an intuitive, real sense. Luck is very important. Experts are usually wrong. And the reason experts are wrong is there are two kinds of experts, right? There are experts that are actually invested, entrepreneurs, investors, people who actually buy the stocks, people who actually go out and do hard work, people who are on the edge of medicine, people who are hands-on, who have something to lose. Those are real experts, in my opinion. If you are just a critic or a commentator or somebody who just sits on the side and talks about something without being invested in it at all or without putting money behind it, then you are simply a critic and you are not an expert. And this is my biggest problem with people who don't actually get involved in the things they talk about. So that's it for this episode. This was a quick primer on stocks. Hope you enjoyed that episode. Thank you for tuning in. Catch you on the next one.